appreciate the collaborative spirit that has driven us to get to this level. If I recall the first days when this discussion came up, it was in the boardroom in Capital Markets Authority. It had a few people with Max advocates, CMA and URSB. And today we are here. We went through the process. The teams were very cooperative. The stakeholders were engaging, giving feedback. And today we have the regulations in place. As URSB, we undertake to support the implementation and to provide our support with these regulations, which are a bedrock upon which the robust and attractive legal framework for private capital is built. The regulations address various concerns. In the past, we had the partnerships regulations of 2010. There were so many issues which could not be addressed. We were not providing for registration of foreign LLPs. And exit of the market wasn't very clear. Now with these regulations, we have clarified on the procedures and steps on how to do this. And now it's implementation. For us to test how good the law is through your implementation and feedback. And it's from this engagement and continuous engagements going forward that we shall continuously improve and provide a favorable business environment for all our businesses. And let's continue to work together to make Uganda a premier destination for private capital in the region. And with that, I want to thank you and wish you a successful deliberations, and we shall be here to listen to you. Thank you.
Ladies and gentlemen, another round of applause to Uganda Registration Services Bureau, who have been at the forefront of the development of the partnership regulations to operationalize the Partnership Act. She has, on a broad sense, talked about very many issues that were highlighted. There were many conversations that were held with the URSB together with YAVCA and the CMA. But really, thank you again to the Uganda Registration Services Bureau. A round of applause again. Without further ado, allow me invite the Chief Executive Officer of the Capital Markets Authority, Madame Josephine Okoye-Osia, to address us. A round of applause as she comes.
Thank you, Terence. Good morning, everyone. It's a pleasure to see all of you here, but the energy is very low in the room. Is it Friday or the breakfast wasn't good? Good morning. Yes, that sounds much better. The Registrar General of Uganda Registration Services Bureau, the Chief Executive of the East Africa Venture Capitalist Association, the officials from IFAD, officials representing FSD Uganda, the CEO, PAL Capital, and the officials representing the Attorney General, distinguished ladies and gentlemen, all protocol observed. Terence said that there was a lot of excitement, and indeed, he is warranted to have that excitement. This journey started 5 years ago, and finally this day has come. So we need to give ourselves a clap for that. So 5 years ago, we embarked on a journey to create a facilitative and conducive environment for private capital to thrive as an alternative source of patient long-term financing. So allow me to appreciate the institutions that have been instrumental in this journey, starting with the Ministry of Finance, Planning and Economic Development, the Ministry of Justice and Constitutional Affairs, the Uganda Registration Services Bureau, the East African Venture Capital Association, the Presidential CEO Forum, IFAD, Max Advocates, and Ms. Laura Bira, who was a technical expert of CMA, the First Parliamentary Council representatives, and the team from CMA, and in particularly the Research and Market Development team. Their dedication to policy, legal, and institutional reform is what has made this conversation today. So let's give them a round of applause. But in a special way, I would like to extend my appreciation to the Registrar General of URSP for the development of the partnership regulations. These regulations are critical to operationalizing the Partnership Act and will significantly enhance the legal framework for private equity in Uganda. Uganda has made bold reforms to facilitate private capital, and these reforms are in line with the National Development Plan 3. So really, we are just kidding in at the end of the NDP 3, and also the Capital Markets Plan of Uganda, which prioritize the mobilization of alternative financing sources through strengthening legal and regulatory frameworks, specifically for private and venture capital. The recently passed capital markets licensing regulations and the partnership regulations provide clear pathways for structuring and registering private equity and venture capital funds within our borders. For the first time, general partners can confidently establish operations in Uganda. The government of Uganda has also introduced tax reforms that significantly improve Uganda's attractiveness for private capital funds, and would like to extend our gratitude to the Ministry of Finance for this effort. This is going to be extensively addressed by the presenters. Together, these measures create a competitive environment for long-term capital formation. In addition to the earlier mentioned effort, CMA has provided support to the private capital space through the establishment of the deal flow facility in collaboration with the European Union and the financial sector deepening Uganda, and has supported over 200 businesses and raised about 6 million from for three companies privately. CMA also approved the Yield Fund and Inua Capital, which demonstrated our commitment to enabling the operation of private capital funds in Uganda. The partnership regulations will allow for domiciliation of the private capital funds locally. And from the capital markets perspective, why is domiciliation very important for us? Firstly, it helps to mobilize both international and local capital. Many local investors are more comfortable investing in onshore vehicles. So domiciling funds in Uganda opens the door for participation for pension funds, insurance funds, and other domestic investors, and particularly for the pension funds where they have restrictions on where the Act doesn't allow them to invest outside the region. I think this is a very good opportunity for pension funds. Secondly, domiciliation facilitates direct investment in Uganda's real economy. Funds domiciled here are more likely to support the local SMEs and high growth sectors. And all of you know the value that SMEs bring to this economy. This aligns well with government strategy as outlined in the NDP 3 and also in the now 10-fold growth strategy, which targets to grow the economy, particularly in the key priority areas of agro-industrialization, tourism, mineral development, and science and innovation. Domiciled funds offer, however, we should note that domiciled funds offer more than capital. They bring expertise, they bring networks, they bring discipline, and their presence can improve corporate governance, boost productivity, and strengthen Uganda's entrepreneurial ecosystem. In addition, it also supports the development of our financial sector. As more funds are established locally, we expect growth in fund administration, legal advisory, auditing, and other professional services, and this creates new job opportunities and builds local capacity. Of course, as I said, this journey started 5 years ago, and it has not been without challenges. Uganda's regulatory and tax environment historically made the operations of private capital funds an uphill task. But today we are seeing meaningful change. The groundwork has been laid, and now we must activate it. As capital markets, our focus is to ensure that Uganda is a well-regulated, efficient, and trusted investment destination. We are committed to facilitating the growth of the private capital space in line with our commitment CMA is also keen on adopting a light touch regulatory approach to foster innovation and growth in the private capital markets. And our legal manager will be speaking to this as she addresses you later. So if you have any specific concerns, please keep the questions for our legal manager who's here with us. In conclusion, facilitating private capital in Uganda is not just a regulatory matter, it's a strategic tool for economic transformation, and it will help unlock investment, power national priorities as outlined in the now NDP4 and the Capital Markets Master Plan, and retain value within our economy. So let's work together to ensure Uganda is not just a destination for capital, but a true home for it. I thank you all, and I wish you all fruitful deliberation. Thank you.
Another round of applause for Josephine. Josephine, allow me to mention in the room quite a number of persons for you to be able to appreciate who is here. Josephine and Patricia in the room is a representation from the European Union, Christina, who is with us. Just next to you is Stella, a quote from IFAD. But also it's important to let you know that you had a meeting, I think, sometime earlier this week with UDB. UDB is represented here. Taib and Susan. And DFF is also here. There's quite a number of representation from various organizations. But I thought it's important for you to appreciate who's in the room. But ladies and gentlemen, without further ado, allow me invite the Chief Executive Officer, East African Venture Capitalist Association, to address us. Christine, please, over to you. Ladies and gentlemen, a hand clap for her.
Good morning again, ladies and gentlemen. I am very pleased to be here today and to witness this momentous occasion. All previous mentioned protocols observed and organizations that have just been mentioned. The East Africa Venture Capital and Private Equity Association, in collaboration with Capital Markets Authority and Uganda Registration Service Bureau, is honored to witness the issuance of the partnership regulations. We should clap for that. Now, just to give you a bit of introduction, EAVCA is the umbrella body for private capital in East Africa, with $3 billion assets under management within our membership of 114 spread across 7 countries in East Africa. Now, as a representative of the private capital investors, this landmark legislation allows VC and private equity funds to be domiciled as LLPs, which is a tremendous step towards advancing Uganda's private capital sector and encouraging economic growth, as we've heard from the CEO of CMA. Now, key provisions include streamlined procedures and reduced compliance hurdles, making it easier for fund managers to establish LLPs in Uganda. And what I can say is you're making work easier for EAVCA to pull investments into Uganda. Flexible management in that fund managers can define internal structures, partner roles, and profit distribution, aligning with industry needs. This will also boost local investment in that the framework is designed to attract both domestic and international capital. As mentioned before, this is going to be a very interesting for pension funds. And currently what we're doing as EAVCA across East Africa is we're really trying to push for local capital distribution allocation. It is one of those tasks that we've found to be an uphill task. However, what we are telling our institutions is that Africa is the future. We need to start looking within, as you've already seen what's happening in the global economies. And so the solution will only come from our own institutions moving forward. Now, looking at the economic impact, The reforms are expected to increase capital flow, since, of course, LLPs provide a more attractive structure for investment, expanding funding for startups and businesses. It would also support entrepreneurs with greater access to capital, which will help innovators to scale and compete regionally and globally. We will also see an expectation of creation of jobs where investment-driven businesses expansion will fuel employment across the sectors. This will also enhance competitiveness by aligning with global standards. Uganda becomes, of course, a more appealing market for investors and for fund managers. Now, as our Uganda country coordinator stated, this is a pivotal moment for Uganda's private capital landscape. With tax-transparent LLPs, we are building a climate that fosters innovation, draws investment, and supports economic progress. And therefore, as IAFCA, we'd like to extend our appreciation to the European Union, Christina, a club, IFAD, Stella Okot, for the unwavering support of the ecosystem and advocacy efforts. We'd also like to appreciate CMA and URSB for championing, thank you, for championing a light touch regulatory approach and working alongside us to shape a conducive legal framework. And I think this is proof that this administration is willing to ensure that there's growth of the private sector, and this is very admirable. We'd also like to thank MMAK advocates, who have been mentioned before, whose foundational legal guidance led to the current framework. I think we've heard that the meeting started in a boardroom with MMAK. Not forgetting, of course, our IAVCA team and board, our country coordinator, and our board committee, represented by Edward today, who tirelessly led the lobbying efforts to ensure that we are here today. Now, I'd like to say that I know there's a lot of misconception around private equity or maybe lack of an understanding and venture capital investments. But what I'd like to say is PE and VC investments are not a Silicon Valley idea, okay? They offer real solutions to our African problems. When you look at this investment, pre-investment, post-investment, even when it gets to government revenue, there's increased government revenue. The impact is amazing when you look at the jobs that have been created by these investments. So this is not a Western idea. These are real investments solving real issues in our African problems. The hospitals that are built, the retail market, the schools that are supported, and especially also our startups and entrepreneurs. And therefore, the private capital ecosystem, I'd also like to thank our private capital ecosystem, our members, DFIs, intermediaries, and professionals. Your commitment and persistence are what drives this sector forward. Today marks a significant milestone for all of us. I can tell you as IAVCA, we are shining with this regulation all over East Africa. We are referencing Uganda and the steps that you've taken to make this easier for our industry. And as IAVCA, we look forward to working together with you in fulfilling our mandate of positioning Uganda as a promising destination for private capital. Thank you very much.
Thank you very, very much for those remarks. A round of applause to CEO IAVCA for this. Ladies and gentlemen, I just wanted to let you know, in case you have colleagues who have not been able to make it here, let them know that we are live on our YouTube channel, Capital Markets Authority, for the international partners or people who may not physically be able to make it. Let them know that we are live on our YouTube platform, Capital Markets Authority Uganda. Just look out for that logo on YouTube. So, ladies and gentlemen, also allow me to recognize someone who kept, I don't know how many doors he knocked, how many offices he visited, but he literally tried to make an effort to ensure that today is a success. I thought it is important to mention Dr. Edward Isingoma, who literally knocked on, I don't know how many doors. Please, a round of applause to Edward for trying to ensure that we can be able to celebrate this. Ladies and gentlemen, CEO IAVCA spoke briefly about IFAD. please allow me just invite Stella to say a few things and her experience with this journey. Just to greet you briefly, and then we can have the presentations. It will be the last speech. Thank you very, very much for your indulgence. Stella, over to you. Round of applause to Stella.
Thank you, Terence. Good morning to everyone. It really is an honor to be here this morning to witness this, this groundbreaking occasion where we have moved the journey since the CEO, CMA said 5 years. Now IFAD has been actively involved behind the scene actually for more than 5 years. It could be 10 years or so. And so we are really excited to see that these efforts have really turned around to bring us all together and make us make this day what it is. Now, briefly about IFAD is International Fund for Agriculture Development. It's a UN agency. It's an international financial institution that has been providing financing to governments, sovereign governments, for agricultural development. And only until maybe 5 years or when we had the private sector window or non-sovereign operations come into fruit, and this allowed for the actively engagement with the private sector. But even so, IFAD, just like CMA, relaxed some procedures to allow certain things to take to shape. IFAD, through the EU, participated in the Yield Uganda Investment Fund. We actually managed the EU funds that were invested in the Yield Uganda Investment Fund that is managed by PCP. And of course, at that time, the environment was not as conducive. Everything else was the odds against the setup of a locally domiciled fund. And so the setup of this fund has been a proof of concept that such type of funds can actually cause ripple effects in the economy, allowing access to finance for small and medium enterprises. And in this case, we fully understand that these are the backbone of most of our economies. And so we've really been behind the scene, pushing, and really excited that this is what has come to be. The regulations are now up for us and opening doors for more and more such type of funds to be domiciled in Uganda. So really, it's a thank you. It's been an honor working closely with the EU, working closely with Edward and the CMA. Actually, in that boardroom discussions, we were in the room, convened that discussion. It could be 5 years ago when we contracted MMAX. So I'm really excited about this development, and we look forward to having more funds locally domiciled in Uganda. Thank you.
And indeed, we look forward to having more funds. These regulations are not to be shelved, they're to be operationalized, to be tested, to have you test the regulations and see what we need to approve. We look forward to having more funds here. Ladies and gentlemen, allow me to invite Max Advocates to make a presentation on the implications of the partnership regulations to the YAVCA members. A round of applause as Max Advocates comes. And then immediately after, we should have a presentation from the manager, Legal and Board Affairs. And thereafter, we will have a presentation from Stephen Tumwesije. Stephen, I hope you run. Thank you. Over to you.
Thank you very much. All protocol observed. Good morning, ladies and gentlemen. My name is Daniela Mushikazikajina. I work with Max Advocates, and we are proud and privileged to be the legal advisors for the East Africa Venture Capital Association in collaboration with the European Union and IFAD in the research and the study that it took to inform the draft and now the gazetted partnership regulations of 2025. And my job here is to just give a brief overview of the study that we undertook, and also to give you an overview of the proposals that we made and how those proposals have been implemented in the partnership regulations of 2025 that we all have before us this morning. So as the previous speakers have noted, the private equity and venture capital space, the private capital space in Uganda has been underdeveloped, and we've only had two funds, Inua Capital and the Yield Fund, that have been domiciled in Uganda, and that is because of the restrictions and the rigidity of the current legal framework as it previously stood. Those two funds were both incorporated as limited liability companies, and they were operating as fund managers that were regulated by the CMA and also registered venture capital funds. But even then, they were not taking full advantage of the legal system still did not allow like the full advantage and the operation that private equity and venture capital funds crave, the flexibility and the light touch regulation that they crave. And therefore, Max was commissioned by IAVCA to undertake a legal gap analysis of the Ugandan legal regime. And part of that legal gap analysis, we undertook to analyze the Partnership Act as it then stood and the partnership regulations of 2010. We also undertook a comparative analysis of other jurisdictions that we felt were, premium destinations for private capital and that had more attractive and more robust legal regimes that would attract capital to domicile and to set up and operate. So part of that legal gap analysis also involved the limitations in the partnership regulations, and then we went ahead to make proposed amendments to the Partnership Act. Although to date those proposals have been realized in the partnership regulations. So broadly, our report made the following recommendations. First, we recommended for recognition of foreign limited liability partnerships in Uganda to allow foreign PE funds to domicile in Uganda. And secondly, we also proposed for clearer laws that would recognize the structure, that would allow for registration, that would provide procedures and processes, that would provide for the proper definition of the legal status, management, cessation of business, and to make it easier for PE funds to come in, operate their business for a term that they have indicated in their agreement, and then make it easier for them to reap their capital and sell to another investor and then leave if they chose to do so. So those proposals are the ones that formed the bedrock for the draft partnership regulations. And we made about 22 proposals for the amendments, and we are pleased to advise that most of those amendments have been taken up. Some of them were even taken verbatim from our proposals, and therefore we're very proud of the work that we have done. So I'll just quickly delve into the overview of the partnership regulations, just to give you a picture and a snapshot of what it would take now with the legal regime as it stands for a foreign LLP or another private capital fund that would like to set up in Uganda. So the partnership regulations, first and foremost, make provision for registration of limited liability partnerships. They make a provision for the procedure, which begins with name reservation under the Business Names Registration Act. And then secondly, they also give a list of documentation and information that is required for those limited liability partnerships that would like to register. And they can provide particulars of their general partners, their addresses, provide a copy of their partnership agreement, and then pay the fees and a slew of other documentation that is required under the regulations. I won't go into depth because I'd like to redeem the time, but the partnership regulations now provide a clear list of what documentation that the LLPs can present to the registrar of companies for registration. The regulations also provide a timeline that the limited liability partnerships can be registered within a period of 15 days, or the registrar of companies should give a decision on whether the registration has been successful within a period of 15 days. And we know that this gives a bit of certainty for the people that would like to set up. And then also the regulations make provision for a specified period of time in the partnership agreement. So they allow the PE funds and any other enterprises that would like to use the LLP vehicle to provide for a specified period of time in their partnership agreement for which they would like to run, which allows for flexibility again, especially in this sector, which is a very important aspect to investors. Then secondly, the regulations also recognize and allow for the registration of foreign limited liability partnerships, and those are the ones that have been established under another territory or jurisdiction that wish to start business in Uganda and establish a place of business. It provides for a certificate of registration that can be issued by the registrar of companies when those limited liability partnerships present the documentations that have been set out in Regulation 9, including, of course, the certificates of registration from their country of origin, the list of the partners, the addresses, and then also the details of their address in Uganda. It's also important to note that previously we did not have domiciliation requirements, I'd say, in our legal regime, but the partnership regulations now require that any partnership, whether any partnership should have a partner that is resident in Uganda. Either the general partner should be resident in Uganda, or any one of the partners should be resident in Uganda. And I think this also will encourage domiciliation and a presence in Uganda, which is, like the previous speakers have noted, which is one of the things that will create stability and also allow for them to carry on more investments. And then the regulations also make several provisions for the protection of the interests of the partners in an LLP, and these take two forms. The first is the provisions that protect partners from excessive liability, and also the provisions that provide limited liability partnerships with the flexibility they need to register, operate, then close their business if they wish to, and sell to the next investor. So for the beginning, on the liability bits, the regulations, in Regulation 11, liability of a general partner for the debts of the limited liability partnership is only limited to where the assets of the LLP are not adequate to cover the debts of the LLP. And therefore, that means that the general partner is not excessively exposed to liability, and it creates an order of priority for the assets of the LLP to be used up first before personal liability is attracted to the general partner. Then secondly, limited liability partnerships. We all know that private capital would like to operate in a manner that is protected and is not overly involved in the management of the company. People just put in their money and they're able to be protected from the liability of the conduct of that business. So, and that's why the LLP vehicle, I think, is most attractive for private capital. So to that effect, the regulations also provide that limited liability partners shall have the protection of indirect liability, and that liability will fall on the general partner, and they shall not cease to have the benefit of limited liability where the partnership does not have temporarily a general partner, and it allows for a period of 12 months for a limited liability partnership to appoint a new general partner, and still liability will not be attracted to them. Secondly, limited liability partners have also been given some power. We know that the general partner is the one who is involved in the day-to-day management and the running of the LLP. However, the regulations in Regulation 14, point out a few actions that the limited liability partners can undertake that will not be considered to be management of the limited liability partnership. And these actions include participating in meetings of the partners, voting on winding up and dissolution of the LLP, incurrence of debt, and that means borrowing or paying back the money, change in nature of the business of the LLP, admission, removal, and withdrawal of any general or limited liability partner. So those provisions, we feel, provide a bit of protection from liability for the PE funds, which we think will provide an attractive environment. And secondly, the provisions that also provide flexibility for limited liability partnerships to come in easily, register, conduct their business, and then be able to dissolve the business if the term for their partnership agreement has run out, or if they have a change of the PASA resolution. So first of all, partners are able or have the authority to transfer their interest in a partnership, either in whole or part, to another person in accordance with the provisions of the partnership agreement. And the regulations, again, like I already stated, make provision for the limited liability partnership to operate for a fixed amount of time that can be specified under the partnership agreement. And thirdly, the regulations also provide that when the limited liability partnership wishes to conclude their business in Uganda, they can pass a resolution, and we just file that resolution with a notice of cessation with the registrar for companies, and then as the registrar directs, they can publish that in a newspaper of wide circulation, and that is all that it takes for them to dissolve the limited liability partnership. So we feel that these provisions provide the flexibility to come in and operate as they wish and as they agree within the partnership agreement. Lastly, on the provision of legal proceedings, a person can institute legal proceedings by or against the limited liability partnership by bringing that, by instituting against the general partner and not against the limited liability partners. So again, back to the protecting of the partners from excessive liability, we feel like that these provisions taken together will provide an attractive environment for foreign funds to domicile using the limited liability partnership vehicle. Another part of our study also looked at the tax regime. I understand that there's going to be a panel discussion later on that will delve into that. But we had proposed that the regulated by the Capital Markets Authority also get to benefit from that tax exemption under the Income Tax Amendment Act. And so we think and we believe that all these developments taken together provide a more attractive legal regime than we previously had for the conduct of private capital business. And these regulations also have other far-reaching effects on other sectors and not just private capital, because for other sectors that would like to take advantage of the LLP model, so this model can also be used in estate planning, and like the previous speakers mentioned, also for pension funds that would like, and other local investors that would like to invest in local businesses. So that's the brief overview of the partnership regulations and the study that informed it. Thank you very much for your time.
Another round of applause for Daniela. I don't know whether it was a mouthful. I know she had to compress a lot, about 5 years of work in 15 minutes. But round of applause to Mark's Advocates for putting this together. Ladies and gentlemen, allow me to invite the manager, Legal and Board Affairs, to just highlight briefly the requirements for PE and VC firms in terms of licensing from the capital markets perspective. Alison, please feel free to address your people.
Thank you, Terence. Good morning. Allow me to stand on the protocol previously observed. But just to add my voice to the previous speakers that have highlighted how important this occasion is in terms of the regulatory reforms that we have been pursuing for the last over 10 years mentioned. And it's a pivotal moment for us from a regulatory perspective. And I know Terence said that I should briefly highlight the requirements. I may be going off script right now. But yes, just allow me take us through what the approval requirements look like in our new licensing and approval regulations, with specific reference to private equity and venture capital funds. Before I delve into the requirements, allow me to give a little bit of background on the motivation behind these regulatory reforms and developments, especially from the CMA perspective. So in terms of the motivation for the reforms, from our perspective as CMA, it took two dimensions. There were gaps from a regulatory perspective. When you look at the CMA Act, we do not have a definition for PE funds. We do have a definition for venture capital, for venture capital funds, a registered venture capital fund, but that is also restricted to a corporate structure, a company. And even while we had the definition for VC funds, the process for registration of VC funds and their approval was really skeletal. And so that created a bit of ambiguity, a bit of reluctance in terms of the process for getting this approval, but also there was ambiguity in terms of the opportunities that would come with this approval and registration. We also did a regional comparison, and this highlighted that we were running behind in comparison to our regional peers. If you look at Kenya, they have a more developed P and VC licensing framework. Rwanda has incorporated this in their CIS regulatory framework. So this regional benchmarking provided a strong motivation for us in terms of catching up with our regulatory framework. At a global level, we observe that regulators are moving towards frameworks that balance innovation with oversight. As most of you may be aware, we are members of the International Organization of Securities Commissions, which is the global body for setting standards for securities regulations. And so even as we were commencing these reforms, it was important that we align with the expectations of the IASCO principles in as far as regulating this space is concerned, issues of investor protection, market fairness, and managing systemic risk, looking at the fast pace at which this space is growing. Now, in terms of opportunities, I mentioned there were two dimensions. And not to take away from the discussion that is happening shortly after this, we are aware that there are tax reforms that were implemented in 2024, and really speaking to benefits around capital gains exemptions, around stamp duty exemptions, and it was important that our regulatory reforms provide an opportunity for these tax reform benefits to actually be realized by the PE funds and the venture capital funds, because as you will hear from the next speaker, the reforms are targeted to those registered funds with the CMA. So in order to take benefit of that opportunity, we had to provide a framework that would accommodate that registration that then links to the tax reforms and the benefits that were coming with those reforms. Now, in terms of our specific approach to regulation, as most of the speakers have mentioned, light touch was our preferred approach or model. And from a global perspective, we looked at different models in the US, in the EU, even regionally, and we realized that this is a similar approach. Focus is on disclosure, focus is on cross-border transactions that the funds are participating in. And while there could be a bit of different aspects here and there that probably provide additional restrictions, especially in the collective investment scheme space, by and large, the general approach is a light touch regulatory approach for the private equity and venture capital space. And so we thought it was important that we adopt this approach as well. Again, it's also aligned with our regulatory philosophy, which looks at market development, but also looks at balancing our regulation with the need for flexibility to support that market development. So I thought it was important to highlight our approach as we developed these regulations. Now, in terms of understanding how these reforms are anchored in the CMA Act, because it has been one of those recurring conversations, you have VCs defined under Section 1 of the Capital Markets Authority Act. You don't have PE funds defined under the Act. So one of the conversations that actually was part of that 5-year journey is how do we navigate this legal, I don't want to call it a conundrum because that may be too sensational, but how do we navigate this? If you look at Section 50(5), it gives us what they would call, it's a broad provision. And as it's stated there, it indicates that nothing shall limit the authority from approving or registering or licensing any person operating in any other capacity which has the direct impact of attainment of the objectives of this Act. So what we have done is, through the licensing and approval regulations, is utilize this provision to exercise the authority's powers when it comes to oversight of PE funds. And of course, it's worth noting that it can apply to any other person that acts in a capacity that is determined to have the impact referenced in this section. But in terms of anchoring this reform in the Act, I thought it important to highlight this so that it is clear in everyone's mind where it is linked in the Act. Now, delving into the actual requirements, I'd like to start with eligibility. Who is eligible for approval? The VC fund is defined under CMA Act, so the regulations are not going to change that. I noticed the audience is 50% lawyers, so I'm sure we all understand what I'm talking about. So the VC fund definition is indicated under the Section 1 of the CMA Act, as has been highlighted there. So that would be the eligible person when it comes to applying for a license, rather for approval and registration under the new regulations. What is critical to note now is the introduction of the definition of a PE fund. And if you look at the regulations, when you do have an opportunity, it broadens the legal structure that can apply for approval. You have a trust, you have a partnership, in addition to a company as would ordinarily apply in the VC fund environment. And this is for purposes of raising capital for investment in businesses with high growth potential through debt, quasi-debt, or equity investments. Now, just to highlight a few distinguishing factors is we have the element of risk capital that is not applicable for the PE funds, which you see in the definition of the venture capital funds under the CMA Act. You have the element of deployment of funds in Uganda, which again, from the PE fund perspective, has been left open. So those I thought would be important to highlight. And then you don't have the investment limit qualification of 80%, which is applicable in the VC fund space. How do you apply? It's a very simple process. We have two forms under the regulations. There's a Form 5 and a Form 6. Form 5 applies where the applicant does not intend to source for investment funds from the public. And rather Form 6. And then Form 5 applies where the applicant intends to, or in future, may want to source funds from the public. And later I'll explain how that manifests. But we are mindful that the majority of funds are being privately placed. But we do anticipate that there'll be a time when funds reach a scale or structure that has systemic relevance or involves public interest. And as such, we've provided for this circumstance in the regulation because the approach for assessment for these funds will differ given their level of risk. I know some of you may have already looked at the forms, so I will not reproduce the details, but broadly speaking, to categorize the required information, you're looking at corporate information, you're looking at details of directors and key personnel, you're looking at declarations made by the directors in terms of their fitness and properness, criminal records, bankruptcy declarations, have you ever been blacklisted from participating in a stock market or any other financial market, details of your capital structure, details of your fund structure, specifically for those proceeding under Form 6, details of your particulars of your auditors that will be auditing the fund. Then that's for Form 5. Then for Form 6, those that do not intend to source investments from the public, unique requirements would be the focus on details of the fund manager or the general partner, details of shareholders or the limited partner. You'll be required to disclose the total size of the fund as well as the details of the investee company. I believe there's nothing, you'll agree with me that there's nothing onerous, and so we do hope we'll have smooth application processes. Now, in terms of course, no regulation is complete without fees, and the fees are very, very nominal. In fact, nominal is, so we have two components when it comes to the fees. You have a one-off registration fees of UGX 750,000, and then you have an annual registration fee of 1 million shillings. Just a quick highlight of what would be expected in terms of post-approval compliance. And again, you'll realize that a lot of these are not necessarily onerous. We have a no objection for change of directors or fund managers that is required, unless that director has already been approved by CMA, probably in another application, then this would be dispensed with. You have a requirement to report material changes in shareholding of the fund. You have a requirement to use a licensed fund manager, and licensed here means licensed by CMA. Then there are a number of requirements, both procedure and disclosure requirements when it comes to removal, replacement of a fund manager. Issues around notification timelines to the authority, issues around the minimum notice period that a fund manager can give when they are resigning, which should not be less than 1 month. Periods around, issues around the time it should take for you to replace a fund manager once they have been, either they have resigned or you have ended the contract, again, which is not less than 1 month. And then also the regulations give guidance into the handover process from the new fund manager and what the types of documents that are expected, the timelines, and the like. In terms of consequences for non-compliance, we do have a provision around revocation or suspension of the approval, which is tied into the CMA Act, but for your comfort, there is a fair and due process that is already provided for. So this would not be an arbitrary revocation or suspension. they'd be expected, there's an expectation that they will follow, that we would follow the due process when it comes to giving an opportunity to hear the reasons related to the non-compliance, and also matching the action, the enforcement action to the non-compliance issue. So the act of suspension or revocation would need to be commensurate to the non-compliance issue being this, that is in question. Now, I would like, having said all that, I would like to highlight that there's an exemption for the funds that do not intend to raise money from the public. These provisions are not applicable. So there is that exemption. Otherwise, for the funds that would have proceeded under Form 6, then these post-approval compliance requirements would apply. Before I conclude, just a little bit on the residual issues. We know there is that outstanding issue of the VC funds. This is an ongoing discussion with our First Parliamentary Council and the Attorney General's Office in terms of what amendments can be reasonably accommodated within the meaning of the CMA Act. So this is an ongoing conversation, and we do hope that once we have concluded those discussions, we'll align the flexibility that PE funds are going to enjoy under these regulations for the VC funds as well. And as I conclude, I just want to mention that this is not really about policing. I think as the previous speakers have mentioned, it's focusing on really unlocking the potential of this space in Uganda and the contribution that we know that it can make. And it's about building trust. We believe that it sends the right signal. It says Uganda is open, it's ready for responsible long-term investment. And so we believe this regulatory reform is a first step in the right direction to back that claim. I thank you for their attention. Terence, back to you.
Thank you, Alison. Thank you very, very much for this very elaborate presentation. When you talked about 1 million, the room seemed to say, yee, when can we bring our application forms? I don't know whether all of you are ready to receive them. Very, very ready, I see. So, because 1,750,000, that's 2 million, surely. For some firms, that's pocket change, but okay. Thank you very, very much, Alison, for the presentation. A round of applause to Alison for that. We will have a panel discussion shortly after this. Please feel free to gather your questions, all the things that you've seen and heard. Feel free to ask each of those questions, and we are happy to answer them within the time frame that we have. We will have a presentation, the last presentation from Mr. Joseph Biaruhanga, who's here from TASLAF, to be able to just address the tax issues. Joseph, in her speech, talked about tax exemptions. What does that mean for the firms that are here? How can one be able to enjoy them? So he shall be able to extensively address that. A round of applause as Joseph comes. So feel free to write down your questions, and they should be addressed shortly after this. Joseph, over to you.
Thank you, everybody. As he said, I'm from TASLAF Advocates. We've been fortunate to have worked with some venture capital and private equity firms in the past, so we're happy to be here. Okay, so the focus of this presentation will be the tax regime for VC and PE. As was already mentioned, last year, there were some amendments passed which were welcome for VC and PE funds. That was both for the income of the funds, of the VC and PE funds, and from them. So this implies that much as the VC and PE funds might make their own profits, even when those profits are distributed, they're equally exempt from tax, which is very encouraging for investors, because you'll be able to extract your profits without having to to deduct taxes along the way. Okay. There was also exemptions that were introduced into the Stamp Duty Act that were relating to the legal instruments legal instruments for venture capital and private equity. So particularly when it comes to the nominal share capital, and when it comes to transfer, injection of capital, and other securities which venture capital and private equity funds would deal in. This was obviously meant to encourage the actual investment into those capitals without having to incur costs as for the Stamp Duty Act. So these were very welcome introductions. However, I'll go into some of the limitations that or oversights that should have been addressed later on in this presentation. Okay. Another proposed amendment, I think you might have been seeing it in the news, is the fact that startup companies, the proposed new tax amendment would have them be exempt from tax for the first 3 years if they have a investment capital of less than half a billion, $500 million, and if they are majority owned by East African citizens. Now, this in itself, like I said, has some good sides and bad sides. I would say it's good, of course, that the URA recognizes the fact that startup companies normally, in their first early formative years, do not easily generate enough cash flows to accommodate both their tax liability as well as reinvesting into their businesses and growing them. So this is a recognition of the fact that a nascent company needs some time to get that financial stability to their cash flows. However, the fact that they've restricted this only to locally owned businesses, while venture capital and private equity is, that sort of capital can come from many different sources around the world. That might be a bit of a limitation to how much this benefit can impact the business environment that we are in. Already enough has been said about the new limited liability partnership regulations that have been introduced. This is of course welcome because it will allow VC and PEs to be able to limit or mitigate their risk exposure when they are coming into an emerging market like ours. So that's another welcome development. Right, so we can come to now some of the features of the tax regime in Uganda which we think could be improved upon. All right, so the provision that private equity or venture capital markets must be regulated by the Capital Markets Authority restricts to a certain extent those that are not based in Uganda from fully benefiting from this tax exemption. We think that's something that we should address in the coming tax amendments. Yeah, go. Then also when we talked about the tax holidays for we're calling it a tax holiday for the startups, the 3-year tax holiday. The fact that again it's restricted to locally owned, majority owned businesses, that are basically businesses that are managed and controlled by East African citizens. This also excludes foreign-based or foreign-owned venture capital and private equity funds from enjoying this tax holiday, and yet this would have been an opportunity to attract much more capital in. So that's something which I think we should probably look at in the next round of amendments to make sure that foreign-based venture capital and private equity interests can see Uganda as an attractive investment environment. Yes, there's also, I think also it's been mentioned that right now, the current legal regime seems to be geared towards venture capital and private equity being existing in forms of corporate entities, companies. And yet, we know from around the world, many of these enterprises are partnerships, and they can take other forms, trusts. Particularly from the point of view of the Stamp Duty Act, they only address legal instruments that would relate to companies. So nominal share capital, the transfer, the purchase, and the like. So these are some of the things which we think could be better, could be expanded to not only consider companies, but also other forms of enterprise like partnerships. The transfer pricing regulations, we have instances whereby you can have a venture capital fund and you might have a management interest in the country. I know there are lawyers here. I hope you have enough understanding of what, I don't want to go too deeply into what transfer pricing is, but basically when you have associated parties dealing with each other, particularly on cross-border transactions, there's a need to have those, any transactions between them to be done at arm's length. Now, the need for, one of the compliance needs for such an occurrence would be for them to not really have a transfer pricing policy, which needs experts in international tax to come and draft for you. It can be expensive. The fact that you have an interest in the country simply overseeing or managing your venture capital, the cost and benefit of having the transfer pricing policy is something that might be of a bit of a concern. So that's something maybe the transfer pricing requirements for venture capital and private equity might need to be revised in order for it to be a little easier to manage. Okay, so VAT. So very quickly go through this. Currently, when you're a startup and you're incurring, you're investing capital assets, right? You're investing into your business, and those capital assets are taxable for VAT. Once you start producing, once you're qualified to register for VAT, you can recoup some of that VAT that you spent during your investment period. But the limitation is only for, if you're not a manufacturer, you can only recoup the VAT you incurred 6 months prior to your start of production. And if you're a manufacturer, it's 1 year. However, we know many investments take more than 1 year before you can start producing. Many sectors, whether in manufacturing or whether it's construction or, so many other business models take more than a year. Now, what would happen is if you cannot claim back this input VAT, it would mean that you have to absorb that cost as part of your cost of investment. And that would then make it you take a longer period to recoup your investment because you have to factor in the VAT that you plowed into the business at the beginning. So that's something which I think should probably be addressed. That short 6-month period should be extended based on the business model of your investment. It's really not, it's not a one-size-fits-all provision that can really work in our investment climate. Another problem we have is capital gains. So many times, not to get too technical, in the computation of capital gains, you basically look at once you're disposing of an asset, whatever that might be, you net off what you paid to acquire that asset, and if what you're receiving is in excess of it, then you have made a capital gain. There have been provisions in the last few years to have that purchase price of that asset indexed. How do I put this? Or have an indexation applied. What that means is that in the inflationary, the value of the purchase of that asset is adjusted for inflation, cut a long story short. And that allows you to have a smaller, if you apply that method, it allows you to compute a smaller capital gain. However, the way that indexation is done uses Ugandan data from the Consumer Price Index that's published by the Uganda Bureau of Statistics monthly. And many times, a lot of these investments are not done in Uganda shillings. So that means when an investor in private equity or venture capital is withdrawing or is disposing of his investment, at the calculation of the capital gains will not take into its consideration foreign exchange fluctuations. It will only look at the inflationary trends in Uganda, which is a short-sighted way of looking at it, which would maybe discourage or it would distort the capital gain that was actually being made in their own country. So, yeah, I think those are some of the main areas of concern when it comes to tax. I'll be glad to take questions after this.
Thank you very much, Joseph. A round of applause to all our presenters for the day. Good morning once again. Leonard Businga is my name. I'm the country coordinator for the East Africa Venture Capital and Private Equity Association. It's a mouthful, I know, just AFCA, so that, yeah, we are not spending a couple of minutes just explaining who we are. But as has been said by all the speakers, it truly is a momentous day for us to be here and to see all of you in the room, your enthusiasm. I know you VCPE players and professionals, you're always very calm and collected. I think it was the CEO of CMA who was wondering, people really, but this is how our people are. You know, this is them at their happiest, they're absorbing, they're excited. I guarantee you I think most of them, though, are wondering, okay, what does this now mean? The laws are out, we have been telling them, we have been broadcasting, saying, guys, change is coming. As the Minister of Finance likes to say, colleagues, change is coming. And now it has come, right? And we're going to have a plenary session, and it's really going to be a conversation. Now that we have gotten an oversight of what the legal regime looks like from the partnerships point of view, from CMA, our regulators, URSB as well in the room, now we want to have a conversation. We want to hear from you. What does this look like? What do you think? What are your initial thoughts? What are some of maybe the pain points that you may still be having, thinking, I don't know, it may seem like a very nice document on paper, but what does it look like in practical terms? And to aid us navigate this conversation, I'm going to invite our presenters back. So Alison from CMA, will excuse our distinguished guests to now join us in the gallery as we now navigate the next part of our morning. So, Alison, please come back. Joseph from TASLAF, please come. You're going to answer tax queries here. I know my people like to, understand tax, because that's a big pain point. I'd also like to invite Mr. Godwin Kakande from Max Advocates, as a partner at Max, to just help us, navigate and understand what this looks like. A round of applause for them even as they take their seats. Again, we encourage you to prepare your questions. This is the time we have been waiting for. Prepare your questions. If you have a question, just raise your hand. Terence will assist us to move around and take your question. Terence is our co-MC for the day. All right, our panelists are now seated. Good morning once again. We'll start with the lawyers. Godwin, you have been part of this process from the very beginning. You did the study that informed the drafting of the regulations. You were part of the stakeholder engagement, even as we were trying to, take stock. Are we on the right track? Do we need to amend, tweak, etc.? And then now you have the final product in your hands. From your professional and also historical point of view, would you say that the document we now have with us is fit for purpose? By fit for purpose, I mean, will it be able to attract these VCPE players more of them to domicile their funds here, knowing that the legal regime is very favorable or not? Please, could you tell us? The mic is...
Thank you, Lenny. Good morning, everyone. Are the regulations fit for purpose? I think it's still early days, but it's encouraging at least to have a document that we can start working with. And some of the provisions we've seen in the regulations emulate global best practices. And here we're looking at jurisdictions like Singapore, Mauritius, where we typically see most of the global well-known PE funds that are domiciled. So in particular, the provision relating to foreign LLPs coming into the country, I think that is a very good provision. And we wait to see what comes next. But for now, I think I would say they're good. And the other point I can probably maybe talk about from a practice point of view is that typically when you see these PE firms, they tend to like quick entry, streamlined process, and then a quick exit. And those are the things that at least the provisions touch on. So from other than having the regulations, we wait to see how it will play out in the market. Thank you.
Thank you so much, Godwin. Alison, thank you so much for... I could tell you were, trying to dumb down the presentation, restrict, try and give us as high level as you could. But there's something I picked out from your presentation. You said that the CMA is adopting a light touch to regulation. Now, for the non-lawyers in the room, what does that look like in real terms, for someone who is maybe considering setting up their fund here or is already existing and they're trying to now convert from the company structure to now come and get licensed with you? What does light touch in real terms look like?
Okay, so when we say light touch, first of all, that approach has already been reflected in the regulations. So you will see that the typical additional requirements that you'd expect in the approval process, if you look at our licensing regulations and comparatively with the other market players, you'll notice that the requirements in terms of the corporate information, the declarations are not as rigorous. And again, lightweight in terms of the process, because it will be a very interactive process. We appreciate that this is going to be a first time of adoption. So there's going to be hand-holding. The process will be very interactive in terms of the information that can be provided. Lightweight at a practical level also in terms of taking recognition of the approvals that have previously been granted. We know there'll be a number of cross-cutting players in the application. We already have a process for licensing fund managers. So we know the for instance, directors that have been given, been assessed for fit and proper. So if the same directors, for instance, are appearing in the application, we will not take you through the same rigorous process to assess the same person that has previously been approved. So those are the contexts I can give in terms of lightweight. From a turnaround time point of view, we typically have a 45-day, and I'm looking at Olive because she's the custodian of this TAT. We typically have a 45-day max turnaround time for these approvals, but just looking at the forms, and I hope you'll really have an opportunity to look at the information that is required. I'm just looking at one of the forms now. There's nothing that would exceed that 45-day period. If you're able to provide your corporate information, because really what we want to do is undertake a due diligence. Luckily, we have an improved system and connectivity with URSB, so we have a more or less 24, 48 hour timeline in terms of being able to get the verifications directly from the system. So that should go a long way, one, in really giving true form to what we mean when we say lightweight, but primarily because that has been reflected in the requirements that have been provided for, and also the post-compliance requirements where we are seeing those exemptions coming to light.
Okay, thank you. I just want to, just a quick follow-up question before we open it up to the members. I noticed that as you were making your presentation, that one of the requirements of the one of the documents they're supposed to present at registration or licensing is they're supposed to provide you with the names of the entities they have invested in, their investees. Now, that might be a bit problematic because typically at the time of registration, we have not yet started deploying. You know, most of the investors haven't yet started deploying. Maybe due diligence is still ongoing. So at that time, there may not be an investee as yet. Now, what they would want to know, would that prevent them from getting licensed? I mean, I don't think there might be a problem with them presenting you with that information post-registration, but I think making it a prerequisite for registration might be problematic, or for lack of a better word, impractical, right? So maybe could you just speak into it?
Yes, if there are no investees at the time of seeking the approval, it's not fatal to the application. You just need to disclose that, and would probably, of course, have to just confirm and satisfy ourselves that that is the accurate position. But to give you comfort that it would not be fatal to an application under these regulations. Yeah.
Okay, thank you. Would like to hear from someone who has been in the wars of this VCPE landscape in Uganda. In our circles, we call him the grandfather of PE, Dr. Edward Matsiko Isingoma. Most of us professionals in the space have either gone through his hands or have worked with him or have gotten a recommendation from him in some way, shape, or form. Dr. Edward, would like to actually invite you here. And the reason we're inviting you is the lawyers and the technical people, they've given us the futuristic. This is what it's going to look like. But we would like to invite you to give us, you know, your practical experience, because you took the plunge with PCP Uganda, together with Yield Fund and NSSF, and you set up the Yield Fund, the first locally domiciled fund in Uganda. Could you, briefly share with the members here what that looked like, approaching the CMA, trying to get some sort of, legal framework to enable you to operate? Yes, Edward.
Thanks, Leonard. I think yes. And morning, everybody. It's interesting to tell a little bit. This has been draining process, but I must say it goes back to when we started. Everybody was setting out in Mauritius and saying we can have LLPs, we can have things set out, and it will work. And the regulations will give the confidence for the investors, longevity, sustainability. And it did work indeed, because our first two funds, the first fund was domiciled here, our second fund was domiciled in Mauritius, our third fund was domiciled in Mauritius, and then our fourth fund, the Yield Uganda Investment Fund, had to be domiciled here. And one of the impact points why the EU pushed very hard for that single country, single sector fund to be domiciled here was, can we have a prototype? Can we have a practical scenario where we have a fund locally domiciled, it can imitate? And at the time, the biggest issue was we had the Partnership Act allowing for the limited liability partnerships to be set up, but then the regulations were not there. And because the regulations were not there, the guidelines were not there, our legal advisors, Dentons, at the time KA, were very, very, very naive for us to have gone as far as trying to then register the Yield Fund as an LLP. So we then registered it as a limited company just like UNEA Capital did. And then the two funds imitated a closed-ended life fund. We had to imitate what we had done with our LLP funds that had been registered in Mauritius, and then work with CMA to actually have that imitation across the limited liability company works. So when you look at our memes and articles of the limited liability company for yield fund, for UNEA Capital, you'll find that we are imitating it. But we are not, we still are talking about yield fund has a 10, 11-year life fund. But that's it. The limited liability company does not have that. But in public, we're actually saying our fund is a 10-year life fund. And come 2027, this fund has got to close. How is it going to close? Are we going to follow the liquidation route if these regulations hadn't come? Are we going to now go back and register a yield fund LLP and then have it in the works? So the journey is still going to have to go on. And if the benefits of LLP are not going to pass on to it because of its registration, is it worth to go through that switch? And those are discussions that have been very helpful to be had with the teams at URSB, at CMA, and have that flexibility that at least as this is all coming through, then we are able to practically have a solution for many of the things. And that's why I think the lady said, if you were to go and register a yield fund now, you already have investees. If you go and register UNEA Capital, you already have investees. And those investees have got to be declared, and that's okay. But for a fund registering for the future, then they would need not have investees registered in there. But then, I'm sure then the real requirements will go around what are those investees going to be looking like, or what are the requirements going to be like for people to be onboarded. Now, to sum it all up, I think this gives us practical solutions of how we are going to move forward, where we're going to end up to. There are issues around tax. We've had a fund before in Uganda, AAC, our very first fund that was domiciled here. At the time, capital gains became a big deal. But our investors, to share with you a practical example, is that our investors gave us capital of $9 million. And we deployed this capital, we returned $7 million. But URA turned around and said, you have a capital gains tax on Forex gain. Because when the investors gave you the $9 million, the Uganda shilling was 1,800. When you have paid them back $7 million, the Uganda shilling is 3,200. What does that mean? According to URA, you have a Forex gain. The investors technically got a gain in Uganda shillings, and that should pay capital gains tax at 30%. And that was an interesting discussion. When we went back to the Act, it did indeed say if the fund was not having a functional currency approved by Commissioner General as a foreign denominated fund, then that tax the investors would have been required to pay tax on the capital gain in shilling terms of about $1 million. But for the investors, it didn't make sense. And it wouldn't make sense to anybody. So it was a big, long, protracted fight as part of the process of the liquidation of that fund. So today, with yield fund, what did we then do? We had to then find yield fund is denominated and the functional currency of the fund is in euros. So it's a 20 million euro fund, closed-ended life, imitated, and we had to get Commissioner General URA to sign off that this will keep its functional currency in euros to make sure I don't have the same problem in 2027 when I've got to close this fund and return capital. And we are lucky that that's now making sense. So practically, you've got to and that gives the real purpose of why you've got to have, if you have a local fund manager who is doing this all the time, you then have got to go through the practicality of working through it. You've got to get through being able to break it down to work with the system and have it allow us function. Whereas if it was Mauritius, this is all embedded in the regulations and it makes a lot of ease. And we are hoping that and I really, really hope yield fund becomes again the first fund to be registered under the rules, because I must say this has been a long run first coming. And so far in the market, we've had about 3 or 4 other people who are now saying, finally, we can register a fund in Uganda. It will now make sense. And having all this work done, and we don't have funds coming and being recognized by CMA and getting to the benefits of this, will not add any much value. Today, it's exciting that we are having these regulations all shared with with stakeholders, but then tomorrow, the issue is going to be how many funds are coming through the process. And as they come through, we're able to refine and refine and refine and get it better. But thanks so much that we were able to get IFAD, EU, and all these other partners to support us as YAVCA and PCP as the pawn, I would say, because we've really had to take the hit in some of the conversations. I can tell you it wasn't fun even when we were talking to the MPs about some of these things. They found it awkward. But we are glad that we are here. And for all our partners that supported us, Max Advocates, Dentons, everybody that supported us, all of you guys in the room, we are so thankful. Thank you very much.
Thank you, Edward. So I'd like to open it up for questions. Yes, Dixon.
Good morning. Dixon Sembuya, Director Research and Market Development at the CMA. Mine are just 2 questions, specifically to the presentation made by the colleague from TASLAF on the tax exemptions. I don't know if we still have those slides. Because
we're going to put them up, but you can ask your question.
Okay, the question was on a statement you made with respect to the tax exemption. I think you said that they don't apply to foreign residents, or I think you'll correct me, or to foreign-based venture capital funds. While our understanding seems to be that the exemptions apply, okay, when you are regulated by the Capital Markets Authority, regardless of your area of domiciliation. Maybe you could just clarify that. Then on stamp duty, I was seeking to understand something you said that the stamp duty exemptions don't apply to the fund because of the corporate nature of the exemptions. And my understanding was that the stamp duty exemptions were designed specifically for the investee companies when you're either acquiring interest or disposing interest in a portfolio or investee company. Maybe you could explain that a little bit further. Thank you.
Can you hear me? Yeah, so your first question, what I'd actually mentioned was the fact that the exemption was restricted to those that are regulated by the Capital Markets Authority. That's really what it was. It was not necessarily to do with ownership, but it was to do with the fact that they must be regulated by the CM in order to benefit from the exemption. That restriction obviously mean that those which are not registered, regulated by CMA would not have that incentive. So it's restricted to that. When it comes to the stamp duty, right, the exemptions that were given was specifically to do with share capital, right? And that is a creature of a corporate, of companies. And it was, in our opinion, it neglected the fact that venture capital private equity comes in other forms, not only in companies. And I think it has been alluded to by other presenters here. There have been some movements in that direction, but when it comes specifically to the exemption of stamp duty, right, it was only addressed to the injection of share capital, transfer of share capital. That's what was exempted in the Stamp Duty Act. So there are stamp duty chargeable or other forms of business partnerships and everything else. But when it came to the exemption of venture capital and private equity, they only addressed the legal instruments issued by companies. So like shares, for example, nominal share capital and transfer, things like that.
Okay, thank you. Questions? Terence, could you help us move the mic around? Yes, there's a question there.
Thank you very much. Mine is a bit of an inquiry. Do we have representatives from URA? Because when we do these things, we tend to have issues with them. They do not get us. Because all these exemptions, I've had bits where we have to do capital calls, but we have to write again to business policy to confirm laws that are out there. So I don't know if we are doing these things, we are having these guys on board, they are not good out there. Even that mere tax exemption status you're talking about, I had to add it in letter from the business policy, yet it's a law that they are supposed to enforce. So I don't know. I need to know if they're here.
Okay, there's another question there.
Yeah, thank you very much. Good morning, ladies and gentlemen. So my name is Remy Wahanze. I work with JEPA Advisory, Africa. So my question is with respect to, and actually just following on what you said, in terms of us having a window, some form of grace period that allows those funds as they transition into the new structure under the LLP partnerships, yeah? Because if you look at the Income Tax Act, what it envisions is mostly as she had explained earlier. Yeah, so I just want to know whether that's going to be provided for, where we can have time for PE funds to sort of like find their wiggle room into this new LLP structure. Yeah, thanks.
I can't speak for URA, but maybe I'd want to throw it to Alison, because I know at the moment we have just the two, INUA and Yield Fund. So if you could speak into, is there going to be some sort of period for them to transition to the new legal regime, or are they going to, do you leave it to the funds themselves to decide whether to continue or to transition? How is the CMA, as much as you can disclose to us, how is it going to handle that?
Thank you. So if you look at the regulations, they do not provide for a transition period. So they're effective, immediate, and they were gazetted 24th January 2025. Now, at a practical level, we intend to issue out a regulatory notice that will provide guidance on how we intend to go about the implementation, because we are alive to the fact that they are existing funds, and definitely there has to be a process to accommodate transitioning to this new regulatory framework. That said, we shall engage to be able to determine what is a reasonable period, but we have to also, now on your end, you have to be mindful of the fact that the benefits under the tax laws can only be realized once the registration process is complete. So you would need to factor that in on your end as you're looking at what is a reasonable transition period for yourselves. Because remember, there may be some funds that decide that the corporate structure is more suitable for them, especially drawing on the discussion around how the stamp duty tax exemption actually manifests as a benefit. So we will engage and we'll issue a regulatory notice to facilitate the transition.
All right, there's a question there.
Yeah, thank you so much for all the information. My name is Carol
from XSML Capital. My question is around the fact that there are very many funds that have opened outside Uganda because there were no regulations here, as we've all seen and all know. But is there an allowance, maybe from the CMA, to have these funds have maybe SPVs within Uganda in terms of if they want to exit some of their investments in Uganda and want to get away or to avoid the capital gains taxes in the future? Is there something that allows that within the current regulations or structures? At the moment, no. I would say you would have to rely on, because it's a three-pronged approach. There are three implementers here. You have the URSB that is taking care of the incorporation aspect, and then the benefits are realized through registration with the CMA and, of course, with URA. So what the regulations are really providing for is once you have incorporated, then you're eligible. Now, this SBV structure has not been envisaged in that scenario because, as you'll notice, the regulations for PE eligibility provide for trust, partnership, and then company. So that's probably something we can look into and see how it will play out in the future, but for now, it will not be possible.
Maybe if I could ask a question, suggestion, request. I noticed that from the room, the number of people who are raising the concern of, there's some pain points, especially around, navigating tax issues, but also trying to now fit into this new promised land that we're going to. We're just wondering, is there room for CMA as our regulator? Because you sit in a privileged position where you're able to freely interact with URA, URSB. Is there room for us to come to you and then you can help us have some of those conversations together as a joint effort, but to lead in that regard? Because when we go there on an individual basis, like I think people have been mentioning, the treatment is a bit different than when it's Alison knocking on the room, when it's CMN knocking on the room, because part of what we're trying to do here is to encourage more people to domicile locally. So now that the legal regime is in place, but it doesn't exist in a vacuum, how can we as the sector players and regulators support the industry to be able to now move and navigate towards that ideal position? Is there room for us to engage the CMA in that regard?
Yeah, I think the people in the room will get more comfort if the champion of stakeholder engagement answers this question. Dix can say something, then probably the CEO can give the commitment.
Thank you. Yeah, absolutely. I think we can always put together an engagement with Ministry of Finance, URA, YAVCA, and CMA, so that we all come to some sort of consensus, or we come up with a common or joint position with respect to treatment, exemptions, etc. So I think we can have that as part of the next engagements that we'll be having with the YAVCA, just trying to engage with the URA, Ministry of Finance. Actually, Ministry of Finance is very, has to be in the room so that URA can take this seriously. So we can put that together and come up with a common position. I don't know, Josephine, if you have something to add?
Thank you. Thank you so much, Dixon. That's very, very encouraging. Is a question, comment?
Thank you. My name is Joel Butaha. I work with B&M Advocates. My question is with regard to the partnership regulations. So you mentioned that they provide now for the registration of foreign LLPs. Now, when I look at the way an LLP is defined in our Partnership Act, when I look in other jurisdictions, I see our definition of an LLP looks like what abroad is a limited partnership. And that's the usual fund structure for funds that are registered as partnerships. And then you will see that an LLP is not exactly what we have as an LLP. So I'm wondering, when it comes to registering a foreign, because I know many funds, we don't have something called a limited partnership in our law, but abroad, in other jurisdictions, that's what they call it when it comes to the funds. So when it's coming to register with URSB, I wonder, it's called a limited partnership and the registrar is looking and saying that this is not an LLP. How will they reconcile that and harmonize it? And yeah, so that it's streamlined, we don't see many queries and things like that. Thank you.
We have a person from URSB in the room. I'll like to direct the question to you. I think we kind of addressed this or tackled this a bit during the stakeholder engagement, but maybe you can expound for those who weren't there in the room on the day.
Okay, thank you. In the regulations, there are requirements of a list of documents you're supposed to provide. So that will suffice and shouldn't be a problem. Yes.
Thank you. Now more hands are going up. Yes.
Thank you very much. My name is Jo Chirunji. I'm principal at Amada Group. My question is regarding fund administration or fund management. I believe, and I might be wrong, that there are about 11 licensed fund managers in Uganda right now, licensed by CMA. And like the gentleman from Max Advocates said, it's early days and we're not sure what the uptake is going to be like now that the regulations are in place. But assuming with all the work that has been put in, the uptake will increase. I'm wondering whether there have been conversations or if there are plans in place either by CMA or the partners in this conversation to increase the capacity in the market such that as we get more funds domiciled in Uganda, there's also commensurate increase in capacity to manage those funds. Is there anything being done to build that capability with maybe other entities that are interested in getting licensed by CMA? Thank you.
Maybe we'll also take the question. There's a hand above you.
Yes, thank you. Good morning, everyone. I am Eric Obura from Inoa Capital. I wanted to provide a more practical example around the tax issues, I think similar to what Edith had shared. I understand the income tax amendment became effective 1st July 2024. But at the end of last year, we were trying to close a transaction, and the investee company in issuing new shares through the URSB system had to pay stamp duty automatically before that issuance is confirmed. And so while we clearly brought this to the registrar, their system didn't have it, and or the registrar who was handling that matter. And so usually in that case, what we would have done is get a sort of letter of exemption from URA for them to change in the back end. But this is a case where the company paid significant stamp duty, and is it something that can be reclaimed or because according to the current regime, they shouldn't have paid, but just because the system couldn't allow them not to pay. So that's more of an example, and if it's a question, because I know there's no one from URA here, but maybe Joseph could advise, should we apply for that refund? Yeah.
Maybe before Joseph, I'd like to first direct it to URSB. From a practical point of view, how can we navigate? Because when you're registering, as you know, on the OBRS, it's automatic, So how do we go about navigating such circumstances?
Okay, if you have such a circumstance, that's when you get a letter from URA, and then we deal with it back end. We cannot exempt a fee without any confirmation. Yes, so if you get that, you'll come, and I know you can apply to URA for a refund. They'll just ask us, they usually write a confirmation to us whether that money was paid. If we say yes, so you'll get your refund.
Thank you. And for the earlier question, Alison, I think it's capacity, Dixon. Okay.
Sorry. that's a bit of a tricky question, and I may not have an answer. But the thing is that once we domicile funds here, okay, and we do so many transactions, okay, I think that should contribute to capacity building, because I think even just going to class and learning might not even be the ultimate solution, but rather the more transactions we do, the better we become. So I think the key thing is domiciling and having as many transactions as possible, and that will build our capacity ultimately. Yeah.
All right, thank you. Is another question?
I think URSB has helped us confirm the biggest problem in the room. They have just told us we need letters to confirm these taxes are exempt. For example, the scenario he has brought out, towards end of year, it was a long period of work to close this investment. And we have assured ourselves, the laws have said no stamp duty. Anyone here that has interacted with URA, you cannot get that letter in a day. These are deals, these are things you're closing. Any day, a mind of an investee can change, something can change. And URSB has just confirmed that these laws are not helping us. If a law is there and I need again to chase URA to get a letter to tell me that my investee should not pay stamp duty, yet the law is there. And to make matters worse, because we already have a letter confirming that from URA, they do not work on that one letter. They want one for each investee. That is very unrealistic. You are two government bodies meant to enforce laws, and you're telling us to tell you to enforce your own laws? No, this is a big problem, and it has just been confirmed, because really we were closing this deal and this came up, and we were like going through URA, this whole process. Let's just pay the money. And if we say we are going to claim this money back from URA, anyone who has interacted with URA, you ask for your money, do you know that audits you go through? That is not something you can even think of. So really, this is a big problem. Let's not ignore it. As we are saying tax reforms and clapping for them, the stakeholders are not making it any easy. So we are not clapping for those tax reforms until the stakeholders make it easier for us to access them.
Thank you for that. And that's actually a very practical example, because it's a real pain point, right? I mean, I can say, maybe one of the practical things, because also, having been on the other side, I know that one of the things you can do to help is, as you start the process of deal closure, you start to engage some of these authorities for approval a bit early enough. CMA has assured us that a conversation is going to be had with URA to make that process a bit faster. But of course, we're not going to stand here and say, no, don't worry, that's done. At a click of a finger, that's going to happen. It's going to be through continuous engagement. So we'd like to invite you, when you're in that process of deal closure, you can tell as you're working on the transaction that it's trending in a certain direction. It's always good to then preemptively engage like URA, so that at the time of the closing mechanics, like the lawyers like to call them, some of these things are already aligned and are in the pipeline. So it's not a magic wand, but it's some sort of advice, even as we continue the engagement efforts to ensure that is streamlined and it becomes quicker and quicker and quicker. All right. Additional comments, questions, maybe? Yes, there's one here from UDB. Oh, and there's another one.
This goes to URSB. How long will we keep blaming the system? The system works for people. It's not a standalone robot. If the system is not in conformity with the law, why don't you configure the system to conform with the law so that we avoid this back and forth? It's not just the issue of taxes. There are certain things that contradict. For example, there's no law barring a minor from being a shareholder in a company, but the URSB system will not register a minor as a shareholder. So you end up being stuck. So Why can't URSB just address the system deficiencies rather than wait for people to run around looking for letters? Thank you.
There's another hand. Yeah, there's another hand so that we can tackle two at a time.
Hello, good morning, everyone. Barbara is my name. I work with PCP. It's a bit front of a question, I think, but I would want to see a way forward. In regards to the post-compliance, the times of reporting, I don't know if that has been mentioned anywhere. For example, if I have yield fund registered today, because most of the documents for yield fund have been coming hand in hand with PCP. So going forward, are there any templates that are going to guide us in reporting? Yeah, it's more of that end of reporting.
Okay, so maybe we'll have Patricia URSB address the system pain point, and then Alison will talk about the reporting.
Okay, thank you. Particularly on the issue of a minor must have a NIN if they're Ugandan, and if a foreigner, a passport. They can own shares. And then on the system, a system is not intelligent. That's why we have to prompt a system on the requirements. And of course, this system was rolled out in December 2022. It's ongoing. We are currently undergoing some improvements, and we appreciate your feedback. Thank you.
Alison, and reporting.
Yes, so if you look at the requirements, the post-approval requirements, the bulk of them, actually all of them, anticipate notification and disclosure of material events. Now this can be done by way of letter. So there's, and again to the point of light touch regulation, we don't have, for instance, reporting requirements on performance, on liquidity, on financial and prudential requirements. So the notifications and disclosures are really limited to material events, change of fund manager, change in the shareholding. This can be done by way of letter.
Thank you. Thank you so much. A round of applause for our panelists. They have done an amazing, amazing, amazing job. Hopefully, each and every one of us is walking out of here more enlightened. But also, each and every one of us, I believe, is walking out of here as an ambassador. Look, it's in all our best interests for more funds to be locally domiciled here. For the lawyers in the room, that means there's more advisory work that comes, more DD work that comes. For the accountants in the room as well, same thing. But even for the investors in the room, that means there's more room for you to actually action that pipeline and also do more work and build this economy together, right? Want to take a moment as EAVCA, East Africa Venture Capital Association, to thank each and every one of you for being here, first of all, but also walking this journey with us. It's not been an easy journey. Some of the doors we have had to knock on, you have to explain all over again. What is it that you do? Why do you need that? No. We have other priorities. But to ensure that we're here, it's taken the concerted effort of each and every one of you. So we just want to say thank you so much. I want to thank Max Advocates. They were our legal support throughout all this process. Godwin, Fiona, and the team, please send back our gratitude. It was because of your opinion that then basically kick-started this whole process. Our supporters, Christina at EU, Stella at IFAD, thank you so much. Thank you so much. You took the walk with us. You took the plunge with us, and we're so grateful. We would not be here if it was not for you guys. CMA, thank you so much. Alison Dixon Sembuya. This man here, you guys, he has been with us through the trenches at every step. It's not always easy to have a regulator a call away, but many times we even just walked into his office and he's like, okay, what do you need? let me see how I can sort it out. So please join us to extend a round of applause. Mr. Dixon Sembuya. He doesn't like to be in the limelight, but we're so grateful for your tireless efforts. CMA as well, the CEO, thank you so much. Thank you so much for your leadership on this. URSB, I know many times when you go to them, we are complaining, this is not working. Why am I, they're unnecessarily querying me. But they have truly walked the talk with this, and they jumped onto the process, and they have given us their commitment that when it comes to registering our LLPs, they're going to prioritize us. So our fund managers, don't worry. We have a friend at the URSB. So each and every one of you, kudos. Let's do this together. Let's do this together. It's going to take each and every one of us. We would like to be here in an even bigger space when there are 100 funds, right, Dixon? So that then CMA will need to occupy the whole building just to deal with PE VC work. So we'd like to invite you, Dixon, to come and give us the closing remarks and bring the day to a close. Thank you.
Thank you very much, Leonard. Ladies and gentlemen, allow me to stand on the previously established protocol. Good morning. Good morning. Great. That sounds better. So mine is just to give a vote of thanks. But I think before I do that, there is one other person that I can't forget. And I'll share an experience. I think 2021, it was Christmas Eve. And I think the Minister of Finance had requested for a note with respect to the tax exemptions. And I think she, I remember I was at home, taking a break. And I recall calling her and telling her, you know what, this is really important, Olive Ojom. So Olive, she's an unsung hero. And she was really playing a role behind the scenes. But guys, first and foremost, as we close this, we've had your pain points. I think URA should be the next assignment for all of us, so to ensure that we're on the same page with respect to taxation, okay? But the other thing is that, you see, we've come up with this set of reforms, but I think we need to test them. It's important that we test them so that we can identify all these weaknesses and pain points. So we're looking forward, from a CMA perspective, we're looking forward to receiving some applications so that we get to test all that we've put in place and identify where the gaps are and probably pat ourselves on the back when there are no gaps. Okay, so please utilize all these reforms, utilize all these changes so that we make this better. I think where there are gaps, we can try and make this better. But all in all, I wish to thank you for availing yourselves. Thank you for taking time out to be here. And we are grateful for that. For all our partners, I think there are so many, and I don't want to mention anyone, but there are so many partners that we've worked with along the way. Thank you so much for the support. And we're looking forward to working together in future to ensure that we make our private capital space as great as possible. So, ladies and gentlemen, in conclusion, thank you so much. And let's make this work, and we look forward to making all the reforms work for Uganda's private capital space and for the betterment of our people as Ugandans. I thank you.
Thank you very much. I have been guided and given one of the most privileges to allow us to disperse. So thank you very much for coming, and thank you very much for your time. God bless you. God bless Uganda.